Drawing conclusions about the future is very difficult, though there are countless analysts and investors who do so every day. They've already determined prices of stocks. They're able to tell you that the Dow will hit 30,000. They can even say with certainty that there will not be a recession for years, if ever. This crystal ball and magical ability is not shared by all, that's for sure. Instead, we can simply look at the data we are presented with, keep up to date, and manage our finances accordingly. You came here for the truth, so let me unveil that for you. Today we're going to look at several economic indicators. I'm going to go all over the map today, and I wanted to cover this issue first. This is out of Northman Trader. You're looking at the S&P 500. The top chart is from 2006 to 2007. The bottom is from 2017 to 2019. And you can see how this looks very, very accurate. The same patterns are forming right now. Does that mean we're going to head in the same direction? Not necessarily, of course, but it does give you an idea of where things are going. What has led up to this point had been too much debt, too much deficit, people making the wrong choices. The same patterns appear. That does not tell you that it's going to crash tomorrow. That is not a prediction, but when you see the same problems, it starts to make you think that it is a good time to be very careful. That's what it should be telling you. This is out of Real Investment Advice. You're looking at the 10 and the 3. This is the inversion of the yield curve, of course. You're looking at the red area at the bottom being the inversion zone. Inversion began May 2019, and you could see historically in the previous instances how this has led to problems. The recessions are the gray shaded areas, just showing you that as soon as we have this occur, once it goes above and it actually comes back above the inversion, that's usually when the recession happens, not when it is inverted. So keep your eyes peeled on this, because we are able to look at this information and it happens to be a repeated pattern. We are not guessing what the price of the S&P is going to be at. We are not looking at Apple stocks to be a certain number. We are seeing risks, we are seeing patterns, and we are able to mitigate some of the potential losses simply by putting our money where it is most safe. I posted this on the blog section of my channel. If you're not already looking at that, you need to, because every couple days or so I start to post on there just random things that I may or may not make a video about. This is one of the things though that I did. Fed's Williams says the yield curve isn't a magic oracle for predicting a recession. Isn't it so fantastic that the Federal Reserve is out there, that they are unable to determine anything in any cycle previously, but yet here they are telling you that the yield curve is nothing to worry about. Why should they say this? Because they're looking at the core PCE rate, they're looking at the unemployment rate, they're looking at all these garbage statistics, and of course their own models do not determine anything on the horizon. They didn't determine that in 2007. Even in 2008 they were still saying everything was fantastic. And go back in history over and over again, the same exact things occurring where this institution is complicit in keeping you unaware. The problems that we have today have been further exacerbated by all of the government's decisions to go further into debt, by individuals' inability to manage their finances properly, and for the establishments, the banks, and the institutions that give people money who really shouldn't have it. We have a debt problem today. Global debt is up by nearly $150 trillion since 2003 and $70 trillion since 2008. All of this debt is tied to a financial product in some way. All of this is connected by derivatives. If you think that there is a problem in Greece and that doesn't affect Germany, that doesn't affect France or Italy or Spain or the United States or Argentina or China or Australia, New Zealand and Canada and so on, you are surely mistaken. All of these derivative products are purchased by countries, by by cities, by states, by regions, by anything possible to make a profit from. And unfortunately, as we saw back in 2008, this started to unravel. That unraveling process was very minuscule. When you look at the actual data, shows us a very, very small amount of it that started to unwind and unravel, and it almost collapsed the entire global financial system. Should this happen again, we're talking about an even larger problem. Even if percentage-wise, it's still the same issue. So we have something going on today that is worse than in 2008, and it is simply being covered up by the same problem that brought it there in the first place. Can you say crazy? Every country is in this mess today, and China is just one of those. Corporates leading the way in China. Total Chinese debt by sector, non-financial corporates, financial, household, and government. And you can see non-financial corporates, my goodness, nearly $40 trillion worth. And this is a very big problem that has grown tremendously since the financial crisis. So since everything was apparently fixed, everything would be okay now, because all of these safety features have been implemented, so you don't have to worry. The financial crisis part 2 will never happen. Janet Yellen said there will be no future crises. Ben Bernanke said it's all good. Jerome Powell said nothing to worry about. So go back to sleep, my little sheep. Then I wanted to flip the page and look at auto loans, the auto industry in general. Auto loans hit a record, pushing average monthly car payments to an all-time high. People are borrowing for such a long period of time. It's crazy. I saw the numbers showing 8 years to pay off a vehicle. 8 years. People buying a new vehicle continue to push the envelope, borrowing more, and on average paying more each month on their auto loan. That takes away from their disposable income. So I had seen the statistics previously, shown it to you many times. People are usually somewhere between $200 and $400 away from having a complete financial meltdown where they have to go into excessive debt beyond their credit card, beyond their student loans. They would actually be going under on a monthly basis. $200 to $400 depending on which study you look at. This takes away from that. So now people are moving up into their vehicles. They got these expensive SUVs and they are unable to actually keep up with it should there be some sort of emergency. The emergency could be a health one, it could be financial, they could lose their jobs, and so on. Credit ratings firm Experian says that the average amount borrowed to buy a new vehicle hit a record $32,000 in the first quarter. Average used vehicle loan is $20,000. People are in debt today, and remember, your car loans, your credit cards, your student debt, and everything all the way up through these financial gambling casino establishments, all of that is connected by derivatives. Whenever I see people talking about how debt is not a problem, they'll just bail it out. They'll take care of it. Oh, they're gonna fix it for us. Or it doesn't matter. Look at all the debt today. We could just print ourselves out of the thing. We have the monopoly. We have the petrodollar. It doesn't matter, doesn't matter, doesn't matter. You do not understand derivatives. You need to pick up a book. You need to put the video down. You need to go and you need to pick up a book and understand what derivatives are. Study it until you realize, then come back here and say that you now fully realize the impact of this. 90 plus days delinquent auto loans in the billions of dollars. This just shows you how excessive the amount of debt people are in because they can't even pay their auto loans. We have 7 million people in the United States, 90 plus days delinquent, showing you specifically how bad things have become. And this is after the financial crisis. Everything was supposed to be resolved. We're 10 years out from the financial crisis. We had bailouts. We had everything to try and make this system go for a little bit longer, please. And yet today we are in a world of hurt. Auto loan delinquency surge, 90 plus days delinquent, percentage of auto loan balance, just showing you that we are back to the levels experienced in 2009. Average loan term, used vehicle in months, this has now exceeded 62. People take so long to pay for their cars. They are way too expensive, number one. Wages have not kept up, and people are okay because why? They're employed. That's right. 3 hours working for Uber Eats is employment. The unemployment rate is whatever, 3.6 or something like this. It's all funny anyway. And do you remember the Cash for Clunkers program? This is something interesting. I don't think people really understood the impact of it, but what it did was gave the car companies an excuse to continue. As a side effect, the program destroyed a portion of the most affordable vehicles, another devastating blow to lower income car buyers in subsequent years. Not only were the most affordable vehicles gone, but by removing this supply from the market, Cash for Clunkers caused the prices up the entire scale of used cars to surge. While it was thought to be a positive thing for the public, it actually was there to help out the big corporations. Are you surprised? I've talked about this so many times before. This is just another one. The issue itself doesn't really matter, but basically we're going towards robots, we're going towards automation. There are many businesses today that are trying to eliminate jobs, everything from the financial industry to construction and so on. We have seen robots just beginning today to start to go into these fields, and they are working on it. It's still in its infancy, but the progress is definitely there because there's a lot of money, a lot of push behind it. So we're going to see where this all goes. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like on this video, you're supporting me. All you have to do is just click one button and you're supporting me. There is less than 10% of people that watch these videos that actually give a thumbs up. So if you could hit that like button, it really does support me. I would appreciate that. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z, the foundation, the history, the asset classes, reducing your debt, and so much more. If you want the audiobook, that's available at themoneygps.com. Do you know what's going on in the real economy? Well, this is actually a fact that 7,200 stores are now closing down in the United States. I tell you exactly what's going on. I show you how to find the data on your own. Click on it and I will see you there.